Hello, everybody, and welcome. This is my lecture overview for intermediate accounting. This is kind of a companion to Wiley Intermediate Accounting 18th edition, their chapter 5. This is part 2 of my presentation on present value. Okay, so my disclaimer and copyright notice: the information and opinions in this presentation are mine, of the author only, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College in the South Orange County Community College District or California State University at Fullerton. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This video is meant to be a companion to the 18th edition of Intermediate Accounting. Those textbook authors are Don Kiso, Jerry Weingate, and Terry Warfield, which is copyright 2022 by Wiley. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay, so in this series where I'm not going to use Wiley's PowerPoints, rather I'm just going to kind of use outside sources, including SEC.gov, to really kind of go through and help you understand the concepts. Now, what I would really suggest you do is get out some paper and pencil, get a calculator, get some present value tables, and work through these questions with me. And I can promise you that the more you practice these, the better you'll get at it. So part of the reason for my making these videos is I lectured on this topic a few nights ago, and this is the fall of 2022 for my intermediate accounting class that I teach online. And it was something that I think that a lot of the concepts that are in here, especially with regards to the effective interest method and imputing interest in terms of how this works, really seem to be a very new concept to many students. So this is why I'm making this into a 3-part video series. So the first part really just dealt with how do we use the present value of $1, present value of an ordinary annuity of $1 to go, and how do we handle a bond payable. That's not going to be covered until you get to the second semester of intermediate accounting, which I believe is going to be in chapter 14, which is non-current liabilities, or it might be chapter 13. But when we're going through and when we see questions where there's like a lump sum amount that's going to be paid to us in the future, in accounting, there's no such thing as free money. And so what we have to do is we have to impute interest. And the way we're going to do that is we're going to take that lump sum and we're going to go ahead and discount it back into today's value. So that's really what the concept is of imputed interest. It's either if it's a below market interest rate, or if it's not, the right interest rate, then that's what we're going to kind of go through and do. Okay, so today we're going to focus if we are given a note payable or if we're giving a note receivable, we're going to basically focus on that one-time lump sum payment. So let's go ahead and take a look at some examples that I've created for our review today. So on January 1st, 2026, YYZ sells equipment to LGA, love the airports. The equipment was purchased by YYZ for $300,000 and has accumulated depreciation of $50,000. LGA gives YYZ a 0 interest-bearing note receivable for $375,000 that will be due on 12/31/29. The market rate of interest for this type of note is 8%. Okay, so let's kind of go through and start from the beginning. We've got to record the sale of equipment. So on 1/1/26, and I'm doing this right now from the perspective of YYZ. So as I'm doing this for YYZ, over here, my date is 1/1/26. When I sell equipment, I got to do a few things. First thing I need to do is I need to take that accumulated depreciation off of the books. Real quickly, let's just go through and kind of remind ourselves of our favorite T account: assets equals liabilities plus owner's equity, ERDC. So equipment is an asset. If I'm going through and selling the asset, I'm going to go ahead and credit equipment for the $300,000 because that equipment is going to be going off of my books. At the same time over here, I have to take the accumulated depreciation off of my books when I sell an asset, right? So that's going to be a debit. Remember, equipment has a debit balance, right? So it's going to be increase with debits, decrease with credits. Accumulated depreciation is what we call a contra asset account. It is going to have a credit balance. So we're going to go show that increase, but when we take it off our books, we're going to get rid of it with a debit. Okay, so now I'm getting a note receivable for $300,000. Excuse me, getting a note receivable for $375,000. However, this note receivable does not bear interest. That's the most important thing about this. And if you kind of think about it, can I just write this here on its own? This amount is not going to be paid to me for another 4 years. This is not the same as $375,000 today. So what I have to go through and do is I have to impute interest. The way I'm going to do that is I'm going to come up here and say, okay, the note receivable amount is $375,000. I go to my present value of a dollar table, and this is going to be 4 periods at 8%. Why is it 4 periods? 26, 27, 28, and 29. So over here, present value of a dollar, 4 periods at 8%. 4 periods at 8% is 0.73503. I'm going to go ahead and put that in right over here. So the present value of this, the value today of this note is basically going to be 375 times 0.73503. So the net amount of the note receivable needs to equal 275,636. So how do I go through and do this? Well, if my note receivable is showing 375 and I need the present value of the note receivable to be equal to 275,636, then I'm going to need a discount of right over here of 99,364. Okay, so right over here, discount on note receivable. Now, let's just kind of go through and make sure that this makes sense. So if I do a discount on note receivable of 99,364, then what does my balance sheet look like? Well, it would look like this. It would show on 1/1/25, it would show the amount of the note receivable less the discount gives me the present value. So by going through and doing this here, I am effectively basically showing this note at its current present value to kind of just give us a kind of a little bit of a like, well, why are we doing it this way? Because again, this is a 0 interest bearing note. It's going to be paid to me in a few years from now. And the thought process behind this is that if I took this amount of money and I reinvested it at 8%, in the first year, I would earn $22,000 worth of interest. So my interest earned, right? So this is the principal, my interest rate, and this would be the principal, or this would be the interest. And then my ending balance or my ending carrying value would be right over here of 297,687 if I'm reinvesting that interest. Year 2, right? This comes over here. Interest rate is 8%. Now this amount over here is 321,502. Year 3, go through over here, invest this at 8%. Gonna make 25,720 over here. Now this is 347,222. Now we're at another 8%, 27,778. And at the end of the 4 years, this is worth 375,000. So this is really the concept behind what we're trying to do. When we record this transaction, if I just showed this amount, it's not going to be correct. Why isn't going to be correct? Well, it's not going to be correct because this amount is not going to be paid to me for another 4 years. So once I have this part of it done, I've recorded the note receivable. and a discount on note receivable. Remember, on my balance sheet, this is going to be showing over here at a net amount of $275. This discount on note receivable, what's going to happen with it is, what does it really represent? Well, it really doesn't represent the gain on the sale. It really represents interest revenue. That's what it is. We're basically, it's basically that discount amount really represents interest revenue. And so that's how we're going to go through and treat it. So over here, when I look at my debits and I look at my credits, in order for me to balance this, right? So the amount I received was $275. The value of the equipment on my books was $250. So I'm going to have a gain on sale of equipment. And this is going to be $25,636. Okay. So this is what I'm going to go through and do when I initially go through and record this if I'm selling the equipment. Okay. Now, let's let's just go through. We'll go through the rest of this example. Okay. So now, again, it's a zero interest bearing note. Now, in terms of cash, I'm not going to be receiving anything until the end of 2029, right? That's when the $375,000 is going to basically be paid to me. But as time goes on, I'm really earning interest, right? Because in the form of this discount on notes receivable. So every single year, what I'm going to need to do, and let's kind of think about this. So, okay, so as I'm looking at this over here, my note receivable, I'm going to be showing over here at $375,000, okay, 1,125. When this note receivable is ultimately being paid out or being paid off, this will eventually go to zero. But what I also need to remind myself of too is I'm going to have a discount on notes receivable. My discount on notes receivable has a credit balance, right? Because it's reducing the carrying value of the note. Now, similar to the bonds, right? What do I need this discount to ultimately go down to? Well, it's a little bit different than the bonds because it's the converse side, but same principle. I'm going to need this balance over here on 1/1/25 by 12/31/29. I'm going to need this balance to go down to zero, because when this note is paid, I'm just going to debit cash and credit note receivable. This discount on notes receivable is going to be amortized to interest revenue. So let's go through and do this. And right, so for the first year on 12/31/26, actually this is 1/1/26, excuse me. So on 12/31/26, what happens? Well, a year has passed and I've earned some interest. So how do I figure out the amount of interest that I've earned? Well, I'm going to take the carrying value of the note receivable. What is the carrying value of the note receivable? It's going to be over here at 375 less the discount. My discount currently is 99,364. This is going to give me my notes receivable carrying value. Okay, so right over here, it's going to be 275,636. What I'm going to go ahead and do is I'm going to take that amount right over here. So this is 12/31/26. I'm going to take this and multiply it by my interest rate. My interest rate is at 8%. So my interest revenue is going to be 275,636 times 8%, or 22,051. So how do I record interest revenue? Well, interest revenue is recorded DC, debit, credit, expenses, revenues. I record revenue with a credit. So right over here, I'm going to be crediting interest revenue, and I'm going to credit interest revenue for 22,051. But at the same time, I also have to look at this discount on note receivable. What's my goal for the discount on notes receivable? Well, I need this to ultimately go down to zero. So the way I'm going to make this go down to zero is on 12/31/26. I'm going to go ahead and debit this balance over here for the same amount, or $22,051. So my ending balance on the discount on note receivable is going to be $77,313. So over here, I'm going to have discount on notes receivable. Okay, so coming right over here. So this journal entry for the next 4 years, at least, the debiting the discount on note receivable, crediting the interest revenue, is not going to change. Okay, so this amount is not going to change. Okay, so this amount is going to stay the same. So this is going to be to record interest revenue. Okay, so we've done the first year. Now, what does the balance sheet look like at the end of the first year? So on 12/31/26, my note receivable is still going to be at $375,000. My discount on note receivable is no longer $99,364. Remember, we want this to go down to 0. So right over here, it's going to be $77,313. My new present, or my new carrying value of the note receivable is going to be $297,687. So what I'm now ready to do over here is I'm going to go ahead and now take a look at the next upcoming year. So over here, so my ending carrying value is going to be right over here. I'm just adding in that amortization of the discount and getting this over here. So now I'm going to come to 12/31/27. My note receivable is $375. The amount of my discount on notes receivable, and let's see where I stashed it, right over here, $77,313. So my note receivable carrying value is increasing, which is what I want it to do. My interest rate is going to be at 8%. That does not change. Whatever, if the interest rates change, we don't care. We want to use the same interest rate we started with. So my interest revenue is $23,815. So right over here, interest revenue, $23,815. I've debited the discount on notes receivable right over here for $23,815 on 12/31/27. So that means my ending balance in my discount on note receivable is now going to be right over here at $53,498. Okay, so my ending carrying value, take the beginning, just add in the interest, and now I'm at $321,502. Let's take a look at our balance sheet. Okay. Okay. So over here, note receivable still showing a gross. My discount on notes receivable is now $53,498. I subtract that. Remember, it's got a credit balance, right? This is a contra asset account. I'm now at $321,502. Okay. So ready to go over here. Let's go ahead and do our next year, or 12/31/28. Okay, remember, this is the beginning balance right over here, and this doesn't have any interest being paid. And this is what happens later on. Okay. So my note receivable, still $375. My discount on note receivable is getting smaller and smaller. My carrying value of my note receivable is now $321,502. My interest rate is at 8%. So my interest revenue is going to be $25,620. Ending carrying value will be $347,222. So over here for 12/31/28, I'm going to debit the discount on notes receivable, credit interest revenue. Come down over here, 12/31/28, basically debiting this discount on notes receivable. So now my discount on notes receivable, right, it's getting closer to 0. That's what we want. So over here, it's now at $27,778. So note receivable, my discount on notes receivable is now $27,778. So my carrying value of my note receivable is $347,222. So now we're getting to the fun stuff. Right over here is the final year of this. So 12/31/29. Note receivable is at $375. My discount on the notes receivable is $27,778. When I go through and subtract this, I get 347,222 at 8%. I multiply this through. And so my ending carrying value of my note is at 375, which is what I want. So what happens now? Right over here, 12/31/29. My amortization of my discount is going to be 27,778, or my interest revenue. And so my balance over here is now at 0. So what happens on 12/31/29? This is going to be 27,778. And that's how we go through and we finish up this journal entry. Now on 12/31/29, I'm going to have one other journal entry that I'm going to be going through and making. And it's going to be cash. And then I'm going to credit notes receivable. And this is going to be over here for 375,000 when the full amount of the note is paid off. So one of the things you'll notice about the way I approach accounting problems, and it's not necessarily going to be the most efficient, but when I teach it, what I like to always do is to try to keep them separated. It's like a famous keep them separated, right, from like the 90s, right? So that's 1990s. So what you're trying to go through, let's find out what that is. Hold on. So this is a song by The Offspring, released in 94, right? So, hey, man, it's like cool. Okay. So right over here, we're going to keep them separated. Okay. So this would be to record payment of the note. Okay. So over here, got my discount on notes receivable. What does this look like over here on 12/31/29? Well, prior to this being paid off, we would be showing over here as 0. And then you'd have over here 375. And then now this would basically go down to, this would actually basically go through and be at 0. So pre-payment, post payment, 12/31/29, it would be at 0. So again, when we have, this is the real important thing, right? So when you see, we have to go through and impute interest, right? So we can't assume it. If you see something that has a 0 interest rate, it's just not true. It's just something we can't do. Okay. So now what we're going to go through and do, so we've done this over here. So we've done the balance sheet. We actually did it for more years, but now we're going to do this from the perspective of LGA. So LGA is going through and buying the equipment, but for LGA, what's going to be a little bit different? Well, for LGA, because they're going through and buying the equipment, how do they go through and record it? Well, the value of the equipment that they're going to be recording is going to be basically determined as follows. So they're giving a note payable, and the note payable they're giving to YYZ is going to be for 375,000. So instead of a discount on notes receivable, there's going to be a discount on notes payable. Okay, so again, it's the opposite, right? To this person over here, because if the interest rate is at 10 or it's at 8%, the present value of this doesn't change. I have to show the value of now the note payable at 275,000. So remember, we're doing this now from the perspective of the other party, meaning the one that's going through and buying the equipment. So over here, my discount on notes payable is going to be over here, is going to be at 99,364. What's the difference going to be? Well, the difference here is going to be the equipment, and we would go through here and record the equipment at 275,636. So as somebody who's going through and buying this, right, this is what I would go through and do. Now, before I go any further, I'm just focusing on the interest and then on the note payable aspect, right? You would normally have to go through, if you buy equipment, what do we have to do with it? We have to depreciate it. So we're not going to deal with the depreciation here. This is really more just to kind of focus on, okay, it's a 0 interest bearing note. What do we have to go through and do? So if it was interest revenue, if this really represented interest revenue for the seller, right, for the buyer who gave the note, this really represents interest expense. So what I'm going to do is that every single year, I'm going to be going through and essentially recording this in terms of saying like, okay, I'm going to debit interest expense. I'm going to credit the discount on notes payable. By the way, just one other note right over here in terms of the balance sheet presentation, right? When I look at this over here, right, this would be non-current asset, non-current asset, non-current asset. And now here, because it's going to be paid within a year, this will be a current asset, current asset. Okay, so what's the difference between current and non-current? If it is current, it's payable or it's receivable within the year, non-current beyond a year. At this point in time, it's non-current. As we get closer to the time period, it's going to become a current asset. Okay, so we now have this over here. So I recorded the purchase of the equipment. So now what I need to kind of go through and do, let's give ourselves some more room down below over here. And we'll even go even further down. There we go. Okay. So I've got this. So I'm sitting on my books. I'm sitting over here with, I've got this discount on notes payable, right? This is a contra liability account, very much like a discount on bonds payable. This discount on notes payable is $99,364 on 1/1/26. What is my goal for the discount? But by the time I go through and pay the note, I want this to be down to 0. So on my balance sheet as of 1/1/26, non-current liabilities, I'm going to have a note payable less my discount is going to be giving me a note payable net. Okay, so over here, my note payable is $375 less my discount is going to give me a note payable net of $275,636. Okay. So this is what my balance sheet looks like as of right now, 12/31/26, 12/31/27, 12/31/28, 12/31/29, right? So it's going to be a non-current liability over here. Then it's going to become current as we're getting closer to when it's actually going to be repaid. Okay. So got my discount on notes payable. What's my goal for this? I need to get this down to 0, right? I want this amount to go down to 0. How am I going to do it? Well, on 12/31/26, what I'm going to need to do to make this go down to 0, I'm going to need to credit the discount on notes payable. And what am I going to have to debit? Remember, what does this represent? It said there was no interest, but as we know, that's not true. In accounting, we have to impute interest. So this is going to be interest expense. Okay, so over here, okay, so this is going to be our journal entry all throughout every time we're going through and doing this, right? So the journal entry is never going to change. When I have this situation in a note payable, I'm debiting interest expense, crediting discount on notes payable, and this is going to be to record interest expense, okay? So over here, debit, credit, so on, so on. Okay. So now what we need to go through and do is to figure out, well, how much interest expense do I go through and record? So let's go ahead and create kind of a similar chart as we went through and did above. So we're going to have our note payable, and this is going to be 12/31/26, 12/31/27, 12/31/28, 12/31/29. Also remember too, you're going to find way more shortcuts. You're probably like looking at this saying, Bennett, like, do you have to really write out all this stuff? The answer is no. But at least when we're first going through and starting out, we kind of want to go, I would suggest doing it this way. So we've got our note payable less our discount on note payable. Discount on notes payable is $99,364. So our note payable carrying value is going to be at $275,636. Our interest rate is at 8%. So my interest expense is going to be over here at 275,636 is going to be 22,051. Might be saying, Bennett, this is the exact same thing as what we just did above. The answer it is, but we're doing it anyways because it's fun. Okay, so we've got interest expense, and then I'm going to go ahead and do this over here. So I'm going to debit interest expense. I'm going to credit discount on notes payable. So I'm going to credit discount on notes payable here on 12/31/26. So my ending value of my ending discount is going to be right over here at 77,313. Remember, our goal is to make this to go to 0. So my ending carrying value is basically going to be 297,687. Let's go ahead and take a look. 375 less my discount is 77,313. My note payable net is 297,687. Okay, so for the next year over here, my new discount on bonds on notes payable is 77,313. My note payable carrying value is 297,687. My interest rate is at 8%. So over here, this is going to be at 23,815. My ending carrying value is going to be 321,502. So my note payable over here is at 375. My interest expense, 23,815. I'm crediting the discount over here for 23,815. So my discount on notes payable is going to be at 53,498. Okay, so right over here, my new discount is 53,498. So my ending carrying value is going to be 321,502. Over here for the next period, 375 less my discount on notes payable, 53,498. My notes payable carrying value is 321,502 at 8% is going to give me interest expense of 25,720. My ending carrying value will be at 347,222. Let's go ahead and do the journal entry. I'm going to debit interest expense for 25,720, crediting discount on bonds payable. Excuse me, the discount on notes payable. I knew I was going to mess it up. Okay, right over here. I'm now coming over here and I'm getting 53,498. So this is me 27,778. So I come over here and now say like, okay, current liabilities are 375. My discount is going to be at 27,778. Over here, my note payable net is going to be 347,222. So we'll say here prepayment. Okay, so now this is going to be 375. My discount on notes payable, 27,778. So my note payable carrying value is going to be at 347,222 at 8% interest. This is now going to be at 27,778. My ending carrying value is 375. Okay, so over here, so this is now, I'm amortizing this by the 27,778. This 27,778 is going to be the amount of the interest expense I'm going to go ahead and recognize. And so now my discount on notes payable after I amortize the interest is now going to be at 0. Okay, so right over here, this is 0. So 375. So post payment, what is this going to look like? Okay, so on basically when I come over here, basically to record the note, I'm going to debit notes payable. I'm going to credit cash. And this is going to be on 12/31/29 when I actually go through and make the payment. So this is going to be for 375,000. And that's how we're going to be going through and dealing with this over here. Okay. So, okay. All right. So, okay, perfect. Okay, so we've got that over here. So post payment, this is basically going to be 0 all the way down the board. Okay. So again, as we're going through and looking at this question, like let's just kind of talk this through. So you want to be going through and using T accounts because it's just going to be that much easier for you to understand. And again, a lot of my videos, I use T accounts everywhere. But when you start dealing with these discounts, and if it's on a note payable or receivable, you really almost have to write it out just to kind of think like logically, like, oh, okay, I need to make this thing zero. So this is what I have to go through and do. So this is the second, this can kind of concludes the second part of this video series. Again, best of luck. It's something you want to spend the time on now. I can tell you from talking with one of my former students who got an 88 on FAR, and this is literally he took the exam in August. And he told me, it's like, look, you just have to make the time. And if you don't put in the time to learn the material now while you're learning it, when you get to the exam, it's going to be a nightmare, because if you're learning something for the first time and you really didn't put the time into it, it's not going to be pleasant. But hopefully and hopefully this didn't put you to sleep like I do to my students in my managerial accounting honors class the spring 2022 this fall 2022 semester. So in any event, have a great rest of your evening and your day wherever you might be, and I look forward to seeing you on the next video. If you have any questions, please feel free to ask me. Send me an email at 1812cpa@gmail.com, and I look forward to seeing you on the next video. Have a great day.